Welcome, everybody, to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and actually have a guest today. So I know I've been kind of skipping out on the guests for the last few weeks, but I brought in a special guest. Now, we're talking about Airbnb just increased fees. If you didn't listen to the part one episode, you need to go listen to it because I broke it down mathematically so that you guys can understand how that impacts you and what you need to do to take action. But instead of bringing in a revenue manager, what I thought to do was to bring in someone, actually one of the consultants from my team, to see how this is changing, this fee change to the host from Airbnb, how it's changing how she's evaluating properties and looking for deals. And so I really think it's going to be important that you pay attention to um, what specifically she's looking for in properties, and then from a number standpoint, how she's analyzing those deals for them to potentially make sense or toss. And it's changed recently. And so pay attention, listen in. This is going to be a really good episode. Take good notes. So without further ado, Rachel from the team, you've been on the show before. Welcome back. Give us a brief introduction for those who don't know you. All right. So Rachel, thanks for joining the show again with us today. I people who've heard you before or people who've worked with you before already know you, but there's obviously new listeners. It's been almost a year since you were on here last time. Tell us more about yourself.
Yeah. So I have been a full-time real estate investor for 2026. I'll make 20 years. I born and raised in New Orleans, Louisiana. Still call this place my home. Um, I've been consulting for you at STR Insights for going on 2 years now, and I've had the pleasure of helping close. I think we're up to 52 of my personal clients, and starting to see a bunch of repeats. But I am I'm one of those people that geeks out on real estate. Like that's my thing. I eat, sleep, breathe. This is my hobby and the way I've chosen to make a living. And I still, as frustrating as there are those days that you just want to bang your head against the wall, I can't imagine doing anything else. I really do love it that much.
Yeah, it is great. And not many people understand it either. You know, when people are like, what do you do? Like when people come and ask you, Rachel, like just a random Joe Schmo, they're like, what do you do? What do you tell them?
I tell them I'm a real estate investor, and that now I do some consulting on the side. So yeah, and that gets a lot of questions like, "Well, wait, so are you an agent?" I'm like, "Nope, not an agent. I buy properties and I improve their value and then I resell them for a profit and I keep some of them and I make some money that way." And just it's given me the opportunity to be my own boss, which is something that I think a lot of our clients that come to us, like that's what they're looking for. I've had the pleasure of doing that for a long time now, and now I guess I'm a little bit spoiled because I it was it's hard. Thankfully, I have a great boss. It's fairly easy to work for you.
I had a nightmare the other night. Literally, I woke. So in my dream, I was back in a corporate job, like 9 to 5, and I was like, no, like I just felt like handcuffed. I was like, oh, this is such a. I woke up like sweating and like I was like, oh, yeah, it's just a dream, just a normal dream. So, yeah, it's so funny. Like a lot of people when they ask me, what do you do? I'm like, you either tell them I'm just a real estate investor or entrepreneur, and they're kind of like, oh, okay, like that's about it because they don't get it. Like it's like, oh, I'm a rocket scientist or whatever. Like that's so much cooler, but just a different avenue. Or I'll get someone who'll say like, "Oh, I own a long-term rental." I'll be like, "Cool." It's like, "All right."
I used to tell people that, like, I don't think I could go do a corporate job, and not that I have a lot of respect for people that do it. There's plenty of people that I've met that are way smarter than I am, but I was just not I was not built for that world.
Right. It's definitely yeah, I've gotten too comfortable in the real estate world where I couldn't see myself doing anything else, so
Yeah. You're the master of your own future. It really I feel like real estate is exactly like school was. You're gonna get out of it what you put into it, right? Like, you alone determine whether or not you succeed or fail, I think, and, I think a lot of people just don't see themselves as the people that can do it, but truly it's something that if believe me, I mean, I had to take high school algebra 4 times. If I can do it, I think anybody can do it.
I can do yeah. Yeah, if half these people are real estate agents out there that are currently you can do anything in real estate.
Absolutely. Absolutely.
Oh goodness. Okay. Well, let's talk about Airbnb, the fee policy. So I look, you're not a revenue manager and we're not talking about pricing strategies. I kind of did a little bit of that in the part one episode. what I really want to focus on with you today is you're consulting for these people, you're finding people deals. How does it change the way you look at data, how you evaluate properties from a revenue standpoint?
Man, that's I mean, this is a conversation that we're having a lot right now, and I've given it a lot of thought. You know, first I want to start off by saying I feel like myself and everyone on our team, we underwrite conservatively, very conservatively. That's always just been my kind of mantra. I would rather show somebody a deal and we obviously, I know that I don't know if the listeners know, but like we estimate revenue on a rate, right? We go good, better, best. I tell everybody when they get down to this is the home I think I'm going to make an offer on. You need to be comfortable with your lowest, your scenario one, your good scenario. If that's all that it produces for you, will you look back on this deal and say, I still would have bought that deal, right? Um, for me now with this change, obviously knowing that there is going to be, no way, shape, or form that this doesn't affect the bottom line unless you price appropriately for it. But as I'm looking at the deals, it's making me be extra cautious with, am I sure about my ranges? And if I thought that something was really kind of cutting it close by my standards, I'm probably now throwing that deal out, which I wouldn't have done prior to this update, right? If it was close and I had a good level of confidence with my data, with the proposed operator, the person that was thinking about the deal, because we're considering all of those things, right? If this is somebody that's got some experience, they're maybe in a similar market, they've done well with that. I might give them a few bonus points that it's not a tangible thing, but it's something that you learn over time that there's nuances to this business. There's nuances to underwriting and how you look at deals at this point, with knowing that we have this extra layer of expense that is all a very, it's a large unknown for a lot of us. I am being even more cautious and probably cutting more deals loose that I might have looked closer at, because if I just feel like it's too thin, I, I'm going to probably pass. I'm going to move on.
Yeah. Yeah. I think now more than ever, it's so important to have that moat, those differentiators of your property. Um, let's actually dive into that a little bit because I think people, when they hear me say it, they have some like preconceived notion of what that means for them. And in reality, it can mean a lot of different things. And so you mentioned we've talked about this before.
I'm laughing because I have a lot of thoughts on this and a lot of people that I feel like we have to kind of rephrase and reframe how they think of what an actual moat is.
Yeah, there we go. So let's talk about it. Let's dive into it because I think this is important. You've helped 53 people or whatever, 52, whatever the number was you mentioned, which is incredible. So, what types of modes are you seeing out there that are helping people be successful in this space?
Well, I think the simple answer for me is, and whether people know this or not, I have this on good authority from somebody that helped to build the Airbnb algorithm, which was quite pleasant to actually run into a client that knew it better than any of us could ever understand it. But there is truth to the fact that Airbnb, the algorithm itself, gives a boost credit, however they grade things, to photos that have water in them. So, we all kind of know, like, oh, a hot tub will bring extra revenue, or a lake view, things like that. There is a lot of truth to that, that the algorithm does love water. So obviously some of the searches that we just run internally all the time, we're looking for pools, we're looking for water proximity, even if it's a creek, right? Something that gives you a water feature on a property can always be great. But I think it's a deeper, just like, there's not a one size fits all. There's not the same mode for every market. I think that's where people really, really, really get hung up, right? Like, let's, you guys bought a hotel in New Orleans, my backyard. This is a city that I know probably better than anybody. I would challenge people on that because I've been investing here for a long time. What I saw in that property that I thought your moat was a parking lot. And that seems mundane, right? But it's valuable. Another investor might not have given that as much consideration as their quote unquote moat, their thing that separates them. But I know that area well. I know the premium that parking is. And I know you know, this is still a city that is quite drivable from a lot of major metropolitan areas in the Southeast. So we do get a lot of drive in traffic in addition to our fly in traffic. So when I say like there's not a one size fits all moat, I think it is market specific. Sure, there are things like if you can find a property, a really great property that has an indoor pool, that's a moat. There's very few indoor pools out there. That puts you into a category where you might be one of one in a market, literally one of one, the only property with the indoor pool. That's going to give you a boost. But when it comes to kind of deciding what a moat is, I think you have to really understand the market as a whole and what does the average property have? That when we look at your property, it might be something as simple or mundane as off street parking, but that can be your moat if 80% of the market can't offer it. Because now all of a sudden, if a marketplace has 5,000 listings and 80% of them don't have a parking, off street parking, in a market where guests place value on that. And I can now be in the top 20% just by that having off street parking, right? That to me is a moat. So I think there's not a one size fits all for that. I think depending on your market, like we have a client under contract in a ski market. They have the only property with an indoor pool in the entire market. The only one. Yes, it's obvious, right? Somebody sees an indoor pool and they're like, "Oh, wow, that's so cool." But it's a market that is so similar in every way that it is very hard to stand out. So it's almost like that is gold in and of itself because it can't be replicated. It'll never be. They're not building on this mountain. There's not somebody that can try and like fake that. This will always be a one of one kind of situation. But you go to another market where, an indoor pool isn't going to be this big deal or it's not something that's possible or even a pool doesn't really matter. Something with exceptional views and then we kind of layer, right? Like does the moat get stronger if I have exceptional views and some kind of a water feature and I have land? Do I have space where I can create the thing that when I look at the other listings in the market, do they have the same land where they can, develop out their quote unquote moat, right? Because we have amenity heavy markets and then we have markets that have this just kind of natural geographic moat. And if we can capture some of that, great. But what if I could get a little bit of both? What if I can find something that's got a stream on the property or a great view, and it happens to come with an acre of land, and some of that's flat, and some of it can be usable. And then I can start kind of stacking up and just really expanding that moat, right? So again, it's not one size fits all, but I think that you can find it in every market, even an urban market where it could be something as simple as parking, or go to a Northeast market where nobody has actual air conditioning. They still have plug-in units, window units. If you're the person who's willing to put the money into putting air conditioning into a house that was built without it or before it existed, a lot of investors don't want that expense. They don't want the challenge of trying to figure out how in the hell do we even get ductwork? How do we get climate control? But the world has moved to a place where they want it. So can we create that? I mean, something as simple as air conditioning can be your mode. It really just depends based on the market.
Yeah, I believe that. In fact, that's one of the problems with my in my one of my properties, the lake one in New York. We these older houses, nobody has ductwork. No one, and people are we all do window units because we only need AC 3 or 4 months out of the year, but people hate the window units. It's like the number one complaint I get on that property, even though it's renovated and updated in a good location. So you get these people from like Florida or the South, and they're used to just central air, and it's like it's not really that common in the Northeast for most houses.
Yeah.
So
I would still never book with no air conditioning. That's me.
yeah, with no air conditioning, yeah, no air conditioning at all. Yeah, that is ridiculous. I would not. Yeah, it still gets warm. So even during the even at nighttime, it's like maybe it's in the cool 70s, but I don't want to just open a window.
Yeah, but I think that kind of leads into like what you're, the concern with obviously the changes, right? I think it's more now more than ever. It's important that we're cautious on our underwriting and that we're also looking to continue that trend of we know that the middle has gotten squeezed out of the market, right? That's happening to short-term rentals. The market, the asset class has evolved. The middle is now getting squeezed, just like every other industry gets squeezed. It's so important that we're layering on ways to differentiate ourselves because if you do have to go and increase your prices to be able to offset this to keep your profit margin intact, it's a heck of a lot easier to do. If you're one of one or one of 10 in a market, it's not going to be very easy for the middle.
I One thing you said I thought was really good. It was a really good point. Is like understand like who the average is. Most people aren't doing that. So you mentioned, for example, indoor pool and one size doesn't fit all. Well, guess what? If you're in the Smokies and you have an indoor pool, that's not really a moat anymore.
Not anymore.
If you're in Orlando and Disney World and you're like, I'm gonna go and theme out my property, that's not a moat either. Like it's not. It's just that's the standard, that's the base. And so it's really important before you go and just start looking at properties and trying to go, oh, well, that property looks special. Understand what the average is in that market because what you might define as special might not really be that unique or special to that market.
I couldn't agree more. And I think take that a step further, you have to understand the trend of where the market's going. So the people that bought the indoor pool cabins a couple of years ago in the Smokies thought that they were one of 10. Guess what? They're still building in the Smokies. And now all the builders are building with indoor pool cabins. So now you're looking for the best location with an indoor pool cabin because some of the best locations have already been taken. They have existing properties on them that can't have the pools because they're already there, right? But it's not as it's not as special as it was 3 years ago. And now you would be foolish to not look to that trend, understand, just ask your realtor, what's the trend in this area? Where is it going? Because what I think is so special today isn't going to be special in
Right.
because once it works and somebody proves that it works and they can make money off it, everybody replicates it. I mean, that's just the reality. So for me, I give a lot more credit to something that I know is such an outlier in a market that's already well established, right? Take the Northeast. I mean, there's a property that I'm thinking of right now that we have somebody looking at in the Northeast with an indoor pool on this like horse estate. It is so spectacularly different from that market and is not going to be replicated, probably not in my lifetime. I would buy that deal even if I thought that it maybe cash flowed slightly less than something else in a market that I knew that market was trending to catch up to those people because I believe that their runway is just longer. And all of this kind of coming to a head with the Airbnb changes and the market, the asset class maturing, you need that. You call it a moat, I call it a runway. Like you need to know couple of years in the future, your revenue is not going to just keep taking a dip because in a couple of years, if you bought on a fairly thin margin and you get a haircut 2 or 3 years in a row, you're the guy who's like, now I need to sell. This doesn't make sense anymore.
That's a really good point. One thing too, I think is, we go into these markets, they're like you said, what's trending. I've been calling amenities arm race. I look at the Smokies. I'm gonna pick on the Smokies for a second, but now I'm seeing everyone put in like pickleball courts, like on the sides of mountains or on their land too. And the people who are putting them in, the first ones putting them in, they're like, everyone loves this. Like this was the best idea ever. But then also, if you track the revenue, it's starting to dip down as more and more people are adding pickleball courts. And I swear in like next year, it's the amenity. It's become the base amenity. I remember on like Facebook, just social media, people were posting like last year before, like, hey, are pickleball courts worth it? Should I add a pickleball court? Now everyone's just adding pickleball courts, especially people with money, I should say. Let me emphasize that part. Everyone with money, that's like one of the base amenity packages. The Fab Five, as I call it, the hot tub, barrel sauna, pickleball court, game room, and then if people are feeling extra spendy, the golf simulator. So, but what you said though, runway is really important. And for me, I think runway correlates to what you bought the property for as well.
Absolutely. I mean, that's the other thing is talking to people that bought at the height of the market. Again, you can't go back and unring that bell, but we now know that there was this anomaly in real estate and some of these markets I get on conversations every day and I tell people don't make an offer on this house. It's just overpriced. Just let it sit and wait. Or you can make an offensively low offer if you'd like, just so that they know we're out here. But you still have to be like an investor first. You have to come at it from a place that you're not, and I struggle with this because I'm mostly not on Facebook getting in arguments with people. I see people saying, it's a business. It is and it's not. It's still real estate. At the end of the day, I've seen some really great places with exceptional revenue sit around because they can't appraise for what the sellers believe that they're worth because because the value simply is not there in the property. Whether it cash flows or not is irrelevant, right? It's got to have the value.
we just had a lender. I don't know if Sheila told you about this, but in the Poconos, we had a lender 4 days before closing come back and drop the appraisal amount by $150,000 because they said it was appraised incorrectly and that it was appraised based on short-term rental rents, not residential comps in the area. And the lender said the or the bank said because of that, we changed the appraisal. This is the real appraised amount, and this is the real loan amount that we're willing to lend on this property. And I mean, it's happening all over the country. I think as people are wising up, to especially the margins thinning in the space. I think the lenders are going to start getting tighter on their restrictions on their qualifications on what they'll lend on in particular. So you guys got to be very careful with that.
No, I agree because I think too the lenders know, they again, just like we were talking about, you need to start forecasting out what your runway is or your moat is in any market, and you have to be looking at the trends in the market before you go into a market. Lenders are still they're doing that all the time, and we're at an inflection point, right? We all know rates are coming down. They're coming down, but the average cost of real estate is still up. It's been held up for a very long time in a way that a lot of people didn't predict for that to happen. And there is some concern that as interest rates come down, again, investors specifically in our space are to blame for some of these markets literally moving because they want a house so bad. They see all the potential. They do have the money to improve the property. They can envision this quote unquote super property. And at the end of the day, they don't necessarily care if they pay $50,000 too much. Like they're not worried because their argument is, well, I'm going to save $70,000 on my tax bill, and by the time I pump all this money into it, it'll certainly be worth that. That doesn't always hold up, and it just takes 4 or 5 sales to kind of reset the comps in a market. If a real estate appraiser doesn't go back and look at the whole body, the entirety of the market over a longer period of time. We've literally seen markets move from short-term rental investors. I'm not going to throw out a list, but there's some of them that we've seen. Short-term rental investors are literally moving markets, and that is also something that I have constantly in my mind. I recommend to people, and I had a lot of these discussions. Push your agents, look at your comps, understand the cost basis in your market. Just because a house is listed at a certain number does not mean that they did any research. That they looked and said, what's the average price per square foot for this size home in this location with these amenities or number of bedrooms, bathrooms, whatever that is. Really do a little extra research to protect yourself because the market right now kind of isn't protecting people. It's a little bit of the Wild West in a way that I've not seen in a long time. I see things appraised where I don't think that they should. I'm actually surprised that that happened in the Poconos, but that's one of those markets that you will find that scenario. We've seen some really astounding performers in the Poconos, but then you see the asking price and you do a little digging and you find out, oh, it's because it only appraised for 1.5 million, but they're asking two, and they just won't take anything less than two. Well, who's going to come in and play a $500,000 appraisal gap? That's absurd. You can buy 3 houses. Don't do that. You know, please don't do that. Yeah, value should still be number 1 on everybody's mind. I don't care what asset class you're investing in real estate. I don't care. It doesn't matter. That is the same fundamental principle that drives it all. You have to understand your value. You have to understand what the thing is worth. Um, and then you really need to understand the money that you put into the property, really understand how that translates to value, if it does at all. Because just newsflash, pickleball courts and barrel saunas don't add value. They don't.
Yeah, that's another thing too. You got to be very careful on is I've seen once again, we're not going to name names, but there's agents out there who are, telling people, oh, well, if you, do this crazy design or make these crazy updates to the property, it will raise the value of the property. And although it might raise the value some, the numbers which they're saying, they're kind of talking out of their butt. They're like, oh yeah, this property will be worth, a million. I'll give you an example. I literally talked to them. They bought this house for like 600 in that range. And they were sold on the idea. If you go and you spend the 300,000 plus in design, decor, and amenities, this property is going to appraise for over $1 million. Okay. They did it. They went over their budget with their designer and they ended up spending 390. Okay. They got it reappraised. It reappraised for 825. So that's, if they got it and they didn't get it for 600, it was over 600, but I'm just kind of keeping some broad numbers here. So even in that case, that's about a 225 gap and you're spending over $300,000 in design, decor, and amenities. Amenities ultimately do not improve the value of the home. And okay, great. If you did get that appraisal, and you did pull that money out, I mean, first off, you're not going to get dollar for dollar back. Most people don't pull their money out. They just want the appraisal to say, like, look what it appraised for. But ultimately, though, if that money isn't real until you sell your property. But if you tried to sell your property for that price point, would someone actually buy it at that price point as a residential home? No, they would not. So, and that's what people need to be thinking. That's when the real estate investor side needs to kick in. Um, Although it's nice and maybe you could, like you could do a cash out or whatever, but once again, you're not getting dollar for dollar back. I just think you have to be very like cognizant of that if you're dumping in a lot of funds into a property.
Yeah. I mean, I know it doesn't hold up as well in the short-term rental space, but as a flipper, you know, for many, many, many years, there's this rule of 50%, right? If I have to spend $50,000 into a property and improvements, I need to see $100,000 in additional value created from that 50. So I need to essentially double that money, right? I still find those opportunities in properties that can be great short-term rentals, and those are the ones that I really love seeing clients that are willing to go after because that gives you that extra going back to like cautiousness and protection and just having a buffer zone, a moat, however it is, you're doing that in your investing as well. Because if I do want to go in and throw in the pickleball court and the barrel sauna, and I spend $50,000 for my rehab, but I have another $50,000 in improved value that I created for myself. Well, now if I go spend $30,000 on pickleball and barrel sauna, I'm still ahead. I'm still ahead. I'm not behind. And that's the game, right? I think more than anything, what this new phase that we're going into is hopefully is going to teach everybody is you've got to be looking at literally every angle. We should all have been doing that anyway. You should be thinking about your exit when you purchase. You should be thinking about the long-term longevity of the market that you're going into and where that market is trending to and where you fit into that puzzle. But the margins are going to get tighter for a lot of people until we figure out, hopefully you'll talk to some revenue managers, the gurus that'll tell us all how to fix this problem. But for a while, it's going to impact people.
Yeah. So I think the lesson here too is the more unique your property is, the better the moat you have. The less of the influx you're going to feel from these fee changes. And ultimately too, like I spent a lot of time talking about this in the part one, so we don't need to dive into it. But you adjust your pricing the right way, you do the math correctly, you're not like the amount the guest is seeing isn't higher. It's just that you're pricing yourself higher in Airbnb, which is going to impact you in the ranking algorithm. But if your property is desirable and more unique, the ranking algorithm isn't just going to drop you down low and you're not going to ever be seen again because it knows that you're consistent and you get booked. Therefore, it will keep you up there. So it's all like kind of cause and effect. But like you said, when we're evaluating what changes is just making sure that we're looking at the ranges. It's not just I have this property is going to make 100,000. It needs to be it's going to make between 90 and maybe 115 or 120. And it's all going to come down to how you're going to operate that property and your ultimate, the stuff you're adding to the property and making it unique. So, but really looking for those properties that have something that stands out. And it doesn't mean you have to go spend hundreds of thousands of dollars either. So those are all key things. Okay. What else? What else you want to talk about with evaluating and the fee changes and so on?
Well, I think the other thing that maybe it's just my mindset. I think more and more people are kind of coming around to this, but just reiterating that, when let's say you have three deals in front of you and one of them is in a mark, maybe has a slightly lower return. I'm not talking massively different rates of returns, but a lower rate of return. and maybe it has a lower ceiling, right? A lower top end threshold. But you know that in that market, you will be guaranteed to be top 10% from the day that you launch without having to build a pickleball court and, spend $50,000 on theming every room. I still value those deals more than I do the one where we can just eke out that extra little bit of cash flow today, but we have to put all this money in and we are still going to be one of 100, not one of 10. Because in a market where you're one of 100 today, you're going to be one of 120, next year, one of 150 the following year. That's just typically how those markets trend. If you can find your one of 10 spot, be the biggest fish in the smallest pond, even if it means a slightly lower return, I'd rather make 5% less, but the same number 10 years into the future than make 10% more today and watch that dribble away until eventually, when you look over the entire 10-year period, you would have been better off just picking the one that was slightly lower, but stable, not shooting for the moon on every deal, trying to eke out every last little crumb, because those are the markets that get affected the fastest. And they're the ones that people end up 2, 3 years down the road. We see those properties come back to market. Why are they coming back to market? Because they're now down 20% from where they started. That doesn't look the same as what if I just started off 5% less, but that 5% less was solid, just stable. There's value for me in that. And I think that investors have to start really looking at that too. If you're chasing a trend, somebody else is chasing it behind you.
Yeah. Yeah. Well, and then too, like if you nail the trend, people are going to follow it, right? So it's
But
all,
it's got an adoption curve. I mean, you talked about that. There's this adoption curve. You're going to watch. You can ride that wave, but you better know it's like playing any other kind of investing game. Know when to get out and beat everybody, because then the numbers start to fall off on the other side. So yeah, you want to chase the trends, go ahead. But if you're a chase the trend investor, you should be the kind of investor that is in and out of deals. Those are not the long haul deals. I like a long haul deal. The short term rentals came to, I think, everybody's mind. They became exciting. Everybody kind of found out about it during COVID. And I think a lot of investors got into this thinking it was this get rich quick scheme. You're still investing in real estate. Real estate is a get rich slow game.
mm,
It is.
build wealth. No, I like that. I really like that where it's like most people struggle. I mean, oh my gosh, there was a guy yesterday, Mungala sent me, she had a conversation with this guy. He's like, I've got, I've got two properties. They have like one has like 400,000 in equity, the other one has like 350 in equity. I'm cash flowing like $300 a month on each property. Should I sell those properties? And I'm like, but the crazy thing is, yeah, I know, right? Yes. I was just like, she's just like asking me, like, what do I say back? I was like, yes, LOL. I'm like, yeah, are you kidding? Like, okay, cool. You want to take what, like 3,600, $4,800 a year, or a backpack full of $400,000 in cash today. I was like, yeah, I'm taking the backpack. So people do not react quickly. They can't. They're naturally like slow processing, second guess themselves because they don't have a lot of experience. In terms of the real estate investing. And I mean, even the guys like this, like, a lot of people listening to this are like, oh yeah, I'd definitely sell too. But the reality is like a lot of the properties that people have, they tend to hold on for longer than they need to. So if that's the case, then you shouldn't be chasing trends.
Correct.
You need to be focused on value and uniqueness of the property. So that doesn't mean you can't pull that off in some of these like more trendier markets. And it's not to say those trendy markets are going away. The Smokies aren't going away. Orlando, you want to be extreme, Scottsdale, Orlando, Miami, like Nashville, these places aren't going away. They're growing and expanding still. But we have to be cognizant of what is the standard, what's the base level, the what I call the minimum barrier of entry into that market from an amenity side, purchase price side, all of those things play into our probability and likelihood of actually finding a deal there. Well, any last parting words of advice or anything else you wanna give?
I mean, no, I don't think so. I think it's still a great time to buy real estate. It really is, truly interest rates coming down. If we get below 6%, everybody and their mother is going to be back into the real estate investing game. If you're listing and you're thinking about it, the again, that runway, the window's closing to get deals. It really is. What those interest rates coming down will mean is the frenzy will be back on. It will be back in a cycle where you lose all of your ability to kind of create the deal that you need. And as Airbnb does make this change and winning on every little piece of a deal is the difference between being profitable and not. Now is certainly the time if you're like, don't wait for the rates to come down. You can refinance, negotiate the deal that gets you cash flow while you still have the ability to negotiate because it's going away.
Yeah. No, that's really good. Yeah, I mean, look, people bonus appreciation's back 100%. Rates are going down. Like that just means more players, lots more competition, a lot more eyes looking in on deals. And so, I can't tell you how many times people have just said, well, what else is out there? And they've missed a good opportunity and they're always kicking themselves. I should have bought that. I should have offered on that, and it's like too late. And so don't be afraid to make moves on properties that, and I've been telling people this too. Like, look, just because you offer and you get something under contract doesn't mean that's a hard stop commitment. It really isn't a hard commitment until you're through your due diligence period.
No, that it's funny that you bring that up. I mean, that cracks me up. People that are afraid to make an offer, like somebody's going to come put a gun to their head and tell them like you're stuck behind this house. It doesn't work like that. Make offers, make lots of offers. I mean, that's the game, right? People that really do this full time, they're writing offers every day or at least every week. They're writing offers, and it's not about getting the volume of your offers up, but the game that they're playing is a probability game. They have their buy boxes, they understand their criteria, what they need to acquire, kind of property to be profitable, and they're just trying to drive the ship. They're saying, "Hey, this is what I can afford to pay you for this deal to work for me." You might have to do that 5, 6, 7 times before you get a yes. And that's fine. Apply that to the short-term rental world. Yeah, it amazes me how concerned people are about making offers and the fact that they've got to kind of go through things from every angle. And it's like, listen, you're splitting hairs at this point. Whether you get a $5,000 credit towards your closing cost or you buy the rate down by half a point, or they just won't come off that 999 number and you want 97. Like in the grand scheme of things, 2,000, 3,000, $10,000 does not make a deal. A deal is a deal without it having to come down to splitting hairs uh, and and analyzing it to death and being so afraid to put an offer. Like if you know what you're doing and what you're looking for, you're not afraid to make offer at all because you know exactly what you need and you know the price that you need to acquire it for and you know where your line in the sand is. Just be that kind of investor.
Yeah, I love it. I love it a lot. Cool. Well, Rachel, thank you so much for joining, giving your thoughts. I know people enjoy it. We got lots of good feedback from the last time last year, so we'll have to have you out on here every once in a while.
Happy to help.
Can't outshine me. I'm just kidding. No, it's great. It's great having someone to thinking these things through as well and bouncing them off. So, um, I
Yeah, of course.
I hope everybody enjoyed listening to this episode, and I'll see you on the next episode of Cash Flow Positive.